Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Bootcamp. We do this bootcamp once a month live to help you learn or build and develop a skill around passive real estate. So if you're here, welcome. Today we're going to be talking about creating an investing plan within passive real estate. So if you're just like, hey, wait a second, I'm not sure if I really want to do passive real estate, don't worry about it. You're in the right place because you're going to be able to take a lot of these skills and translate them into other areas of passive investing. But all of our examples today are going to be around passive investing. Now, if this is your first time joining, you're in the right place. If you want to learn how to turn your income and savings into long-term passive income and wealth. Now, maybe you've tried investing in a passive investment before and just couldn't quite get comfortable, or maybe you invested in a deal and went, oops, I did a ready, fire, aim, I made a mistake. All right, it happens to the best of us. Or you just simply want to sharpen your skills and become a better limited partner in passive real estate. If that is you, you're in the right place. Now, a little bit about me. I'm the Director of Investor Education here at PassiveInvesting.com, but this is not what I do, the only thing that I do. For me, passive real estate gives me freedom. It gives me not only just financial freedom, but it gives me freedom of choice, freedom of time, freedom to create an impact in the world, which is what I get to do here with you, but also gives me location freedom. And that is super important to me because I love spending time with my crazy crew. As you see here, my family. We loved spending tons of time in the outdoors. Right now, we are in beautiful Sedona, Arizona, spending some time here around the holidays. But what's allowed us to do that is focusing on scaling our passive real estate portfolio. We've done the active. We've scaled over 800 million in an active real estate. We've done the flips. We've done over $5 million in real estate flips, but really it is learning how to take that income that we were trading time for actively and put it into passive real estate deals. That is what unlocked the golden handcuffs for my husband and I, and it has allowed us to step in and live life on our own terms. And I want to help you do the same thing. Now, I also have, if you want to see more of my journey, you can find out more by, following me at ashwealth.com or reading my book, published with Bigger Pockets. For me, I'm the author of Money for Tomorrow, How to Build and Protect Generational Wealth. And here's where you can get a copy of that book if you'd like, and dive deeper into some of these concepts. Now, again, what we are learning to do in passive real estate is to give you 100% control and choice on how you spend your time. Money is simply the tool on how to get this result. Now, when you have control and choice on how to spend your time, you can do whatever it is you want. You can live life on your own terms. Maybe you choose to work. I choose to still work. My husband still chooses to do some work as well. But we can, at the end of the day, we can help you do that here at PassiveInvesting.com. And we can help you invest across all different layers of the capital stack. Whether you are wanting to be in kind of more the higher risk, higher reward equity deals, say like multifamily, express car washes, uh, uh, self-storage type deals, or if you want to be in the lower tiers of the capital stack, a little lower reward, but more stability and give you that smooth out that volatility in your portfolio. We've got real estate debt fund. We have a preferred equity fund. We have promissory notes that are open. So if you're interested, reach out to me at passiveinvestingwithwhitney.com. There you can get directly scheduled on my calendar, or via email, whitney@passiveinvesting.com. And here's all my contact information. Not going to make you wait until the end. But there's some perks if you want to join us at passiveinvestingwithwhitney.com. And if you're looking to place capital before the end of the year, we can help you do that. Especially, we don't have equity deals open right now, but we have a preferred equity deal, some promissory notes, debt funds that you can take a look at. Now, today we're going to talk about how to create an investment plan. All right, this is not you sitting down with a financial advisor and them telling you what they're going to place your funds in. Okay, this is you taking control over your investment decisions. Okay, now today I want you to know that this is not financial advice. This is not legal advice, not tax advice. Okay. I still want you, any decisions you make today, I still want you to partner with your investment team before going into your next investment. Okay. But this is going to put you in the driver's seat, which is what we want. Because often I know when I've talked to financial advisors, I worked very closely with my mom's financial advisor when she was alive. She was told what her goals were. Okay. This is not how we want life going. We want to be in full control. All right. So let's get started with the investing plan. Now, if you're here live, I want you to open up your chat box. Okay. Because I can't see Q&A live on screen. And I'm gonna pose some questions to you as we go through this. Okay, so when we talk about why have that investing plan, okay, and let me back it up just one step. One of the number one mistakes I see passive real estate investors make, and actually, honestly, just active, any investor make, whether active or passive, is they go, great, real estate helps me build income, equity growth, gets tax benefits. Let me figure out what deal to go into. Okay. Keep in mind, real estate, or maybe express car rushes, you're investing in businesses. Those are all tactics. We have to get back to the strategy. Okay. And having that investing plan is the strategy that will then drive what tactic we execute. Okay. So, I say this all the time on various webinars. This is the key message in my book, Money for Tomorrow. Investors go wrong when they put the cart in front of the horse, when they start investing in deals and they don't have the plan in place. Okay. So if you don't have a plan, if you don't know where you're going, any path will get you there. If you don't have a plan for your money, guess what? Somebody else does. All right. So we want to make sure that we are keeping you focused on your goals, confident in your decision making, and disciplined, especially in uncertain markets. Okay. Those three things, okay, if you have those included in a very solid investment plan, all right, and we're not talking cool numbers and graphs and charts. This is just you writing a document, an investment thesis, an investing plan for yourself. If you have those three things, okay, you now are looking for deals that fit your plan. Not just looking at deals and wondering, does it help me reach my goals or not? Okay. So the takeaway here is your investing plan informs your due diligence process and prevents you from making costly mistakes. Every time I've heard an investor make money, or not make money, but lose money, myself included, okay, it's not a matter of if a deal will go sideways or south. It's a matter of when, okay? It's usually because the investor violated a decision in their investing plan or didn't actually have that bullet in their investing plan to know to interrogate that. All right. Okay, so let's get a little bit further. What are the steps here? So the first step is to make sure to define your goals and your financial stage. All right. I love people being part of investing groups. Okay, there's several out there. Passive Pockets, all right, Boulder Investment Group, Long Ankle, okay, just to name a few, Crowd DD. But here's the number one mistake I see investors make. They get in these groups and then they look for deals and they're seeing somebody else that's really cool, really knowledgeable, that's done a lot of vetting on the deal. And they say, great, that person did all their DD on the deal. I'm going to go invest because of them. Happens all the time. And quite frankly, if we think about it, if we've had a deal go south in our portfolio, we'll probably, I'm guilty of this too. Long story short, those groups can be what we call echo chambers. So how do you stay out of the echo chamber? All right. How do you leverage the group's power to help you find deals, find operators? It's that you have this investment plan. So you have clearly defined goals and you know your investment stage. That way, when you see somebody that goes, this is the next amazing deal since sliced bread, okay, you can be like, I'm going to vet this according to my goals and my risk and my timeline. It either matches or doesn't, and then I can move on. All right, so what does that look like? First, we have to actually ask ourselves the question, do we even like real estate? If you don't like real estate, if you don't believe in it as an investment vehicle, okay, then investing in passive real estate is not your jam. You need to find something else to invest in. Stocks, bonds, and mutual funds, okay? And every investment vehicle is going to have its own pros and cons, all right? There is not a golden investment vehicle out there that's zero risk, okay? But first question is, do we like real estate? If you're here, you probably do, okay? You probably believe in real estate as an investment vehicle. The next question is, do you need capital preservation, cash flow, equity growth, pass-through tax benefits, or do you just simply need to leverage, returns, amplify your returns through leverage, use of lending? Okay, do you need inflation hedging or do you need diversification? Now, I encourage somebody might be looking at this and they go, yes, I need all of that, okay? Order the top 3 here. What is most important to you, okay? And then once you have those top 3 ordered, and I want you to start ordering those, put those in the chat box right now. I want to know what you're thinking, okay? Then tell me the top one that you need from your investment. All right, again, this is interactive. We're going to build our plan together here today. So go to your chat box and let me know, what are your top 3 goals when it comes to investing? All right, anybody? We got a lot of silence here. Either you already have it completely dialed in, or we're kind of stumped here. You're stumped. You have questions. Okay, we got capital preservation, another person cash flow, another person, ooh, here's a great example. Okay, so I've got several people that have chimed in. One person needs capital preservation, then equity growth, and then diversification. Another person says, I don't care about the capital preservation. Okay, that's cool. They need cash flow, then tax benefits. All right. So you see how if you're in a group scenario and you guys are all looking at the deals together, but everybody has a different lens on how they're looking at the deals, things can go a little bit off the rails here. Okay, so make sure you got these dialed in. All right, so it looks like a lot of people are looking for capital preservation and cash flow. Okay, great. Right now in this part of the market cycle, and you know what? I'm not going to get ahead of myself because we're going to talk about that market cycles here in a minute. All right. So we talked about step 1, know your goals, right? Now here's the thing. You're going to have a goal today and then a goal that you're shooting for. Okay. So for those of you, when you put your goals in there, what is your today goal when you look at those 3 goals, and what is your tomorrow goal? And here's how I look at it. I look at it as, and these are borrowing from Tony Robbins' work, okay, in Date with Destiny. He, categorizes 5 financial milestones. Okay, the first milestone is that you're hitting financial security. You just need to have your essentials covered, okay? Enough cash in the bank. That way, like if you lost your job or your business went under, that you could just keep the lights on, the heat on, food on the table. The next thing he defines is financial vitality. This is where, okay, great. If you lost your job, your business went under, okay, you have enough cash in the bank that you have, not only your essentials covered, but a little bit extra, just some modest living. Like you could, get a new shirt every now and then, go to dinner every now and then. All right. You're not living a lavish lifestyle. You're not even living your current lifestyle. Okay. But things aren't so bad. All right. Now, then we flip the switch. Financial independence. All right, this is not all about having cash in the bank. This is about having enough cash flow coming in that all your expenses are covered passively. All right, now the cash flow, we normally think of it regular distributions, but even if you have a series of equity deals that are cashing out over time, that could count as cash flow. But you got to have enough to reinvest to keep that machine going. All right, then financial freedom is, do you have enough cash flow coming in to live your ideal lifestyle and have it funded passively? And then there's the tier absolute freedom, which is just you have unlimited choices, unlimited opportunity. You're buying islands and a plane and all this sort of stuff. Okay. Now, so if we're combining our goals, right, I want you to tell me, or when we look at our goals, where are you today? Where are you going? All right. Put that in the chat. Where are you today and where are you going? Say like in 5 years or 10 years. Okay, I've got one person that is at security and they in 5 years they want to be independent. Okay, awesome. Then I have another person who's independent and they want to have absolute freedom in 5 years. Okay, that's awesome. Right? So you see we have all different phases of investing. Somebody is like financial vitality today, tomorrow they want financial freedom. Okay, fantastic. All right, cool. Independent, working towards freedom. Awesome. Okay. So now I want you to sit with what you just told me, where you're at, where you're going, and look back at what you named as your goals. Do they align? Okay, because we need to, you know, the milestones that we're putting in place, we need to make sure that our goals are aligned. Okay, what does unalignment look like? If somebody is moving from security to independence, okay, in 5 years, then you might be, equity deals might make more sense. But if you're looking at moving from independence from freedom from 5 years, it's all about the cash flow. Okay, how quickly can we build that cash flow and equity growth at the same time? Okay, so you're going to want to have more of those, what we call pillars of wealth: cash flow, equity growth, tax benefits, in the lower layers when you're moving around security to say upwards towards freedom. But if you're just going one tier in 5 years, you can get away with just having like 1 or 2 of those pillars. All right, we'll get more into the weeds in that here in a second. All right, well, we got to put one more element in here, or 2 more elements really. Step number 2, analyze what kind of risk in your timeline. Okay, so the lowest risk investments generally produce the lowest value in return, but tend to have the fewest losses. The higher risk investments may produce higher values, but you're more swinging for the fences on a deal, to borrow a baseball analogy. So you could lose a little bit bigger too. All right. So I want you to sit here and ask yourself, when we're assessing risk, we're only assessing risk in the slide, what would keep you up at night? Okay, ask yourself, what would keep you up at night when you're in a deal? Is it reduced or paused distributions, suspended distributions? Is it business plan risk? Maybe like the timeline got extended, there's cost overruns. Is it a capital call, having to make unexpected contributions to a deal? Is it actually like the deal goes under completely, and you lose all your capital? Or, is it just something like, a bad actor and there's fraud? Okay, what would keep you up at night? Go to the chat box and type that in. Fraud, yeah, that keeps me up at night too. Loss of capital, okay. And it can be multiple things. It doesn't have to be one thing, okay? Write down those things that would just kind of make you sweat at night. You would lose sleep. And the reason why I like thinking in terms of sleep is because, 1, I don't make good decisions if I haven't had a good night's sleep. But 2, those are the things those usually indicate what you're not able to actually tolerate. Okay, they're going to cause you undue stress. Somebody said all of them would keep me up without a buffer in place. Well, and that's what we're looking to do. That's why we do due diligence. Okay. is so we can like eliminate some of these things off the table. But what are the big things that are just going to be like, if this happened, I'm going to have heart palpitations, we're going to have issues. Loss of capital. Okay. Oh, accounting errors in my K1 creates erroneous tax liability. Okay, well, I would put that in like an unexpected capital call, but not in the capital call that you would traditionally think of. Because if you have an erroneous issue and you have to like unwind some taxes, if the accounting wasn't done appropriately, all right, now you're going to have to like pay taxes on something that you weren't expecting to pay taxes on. Okay. All right. Now here we want to make sure that we're looking at risk, okay, in relation to our goals, in relation to the kind of our milestones of investing. But we got one more layer to add in here, and that is the timeline. Where are you in your current investing stage? Okay. Are you in the accumulation phase? Do you have like 15, 20 years to go through at least 2 business, investment cycles before you retire, or before you need to reposition before you retire? All right. I would say at least 2. Okay. And we used to think of an investment cycle as 5 years. It's probably closer to 7 years now. I would leave yourself some leeway there. Are you in a transition phase? Is it that you can maybe get part of your portfolio through one more investment cycle of say 7 years, but you need to start thinking about how do I transition part of my net worth, my equity into cash flow assets to prepare for retirement? Okay, you're moving from growth to income. Or are you at that retirement phase? Are you in the cash flow phase, meaning that you just either need, because of age or because of just your net worth, that you're like, hey, enough is enough. I'm going to get off of the equity building hamster wheel. I'm just going to, lock in my chips and start building cash flow. Okay, tell me which phase you're in. Go to the chat box. Okay, cash flow, transition, cash flow. Well, okay, well, you guys say cash flow. Cash flow can happen in the accumulation. Oh, okay. Sorry. Never mind. Okay. I see what you guys are saying. Cash flow phase, not what you need. Transition, cash flow. Okay. All right. Now that we've got all these puzzle pieces in place, you're looking at them on your sheet of paper. Somebody said, I'm in the retirement phase, but I consider myself transition because I have aggressive equity growth goals. Ooh, okay. You're the perfect example. We're going to pin your comment real fast. But for everybody that has identified their phase you're in, now what you want to do is make sure, is the risk you're taking and your goals for investing, do they align with the cash flow, the phase that you're in or the phase that you're heading to in the next like 2 to 3 years? Do they align? Now, the last comment I just read, I'm in the retirement phase, the cash flow phase. Okay, we'll call it that. But I considered myself in the transition phase because they have aggressive equity growth goals. Okay, one, that investor knows what they've named what they're doing. So they are willing to take more risk, or they, because they're in that transition phase, in order to get what they want. Now, sometimes this happens because investors come in late to the game. I wish I knew about passive real estate investing in my 20s. It would be amazing. Like I could have taken a nice long, investment timeline to build my wealth. Okay, take lower risks. I wish I would have loved that, but I found that much later in life, and so I had to take a little bit more risk. Okay, now sometimes risk can be great. We're going to pin that to the market cycles and the debt cycles here in a second. All right, we're gonna really level set our risk here in a minute. But for somebody like my daughter, she's investing now. She's 12. Okay, she can take a nice long ride to start building her wealth. All right. Okay, so as I promised you, market cycles. This plays into how much risk you, or when you should take certain risk. Okay, so I did a webinar back in end of September, I think, early October, on market cycles and debt cycles. Did 2 webinars. Okay, we want to take a look at how these guys interact, because this interplays on when we are going to take certain risk. So the 4 phases of the market cycle are: phase 1 is recovery. Okay, phase 2 is expansion. That's when, things are starting to grow. Phase 3 is hypersupply. All right, and then phase 4 is recession. Okay, now headlines like to talk about that the whole United States is in the same market cycle at once. Okay, but that's simply not true. Market cycles happen locally, regionally, and even like locally. So your market cycle might be different than somebody else's market cycle. If you're in the West Coast, you might be in a different market cycle than somebody on the East Coast. Right? So take a look at the areas you're investing and what the market cycle is. Okay. The past couple years, we've hit hypersupply, and some markets are still moving through hypersupply right now. They haven't even hit the recession part yet. They haven't fully bottomed out. All right. Some have hit the bottom and they're coming in through what we call absorption. Okay. They just got about another 6 to maybe 18 months to fully absorb their hypersupply, and then they're off to the races and they're going to boom. Okay. The markets you love investing in, what is their market cycle? Do you know that? Where are they in the market cycle? Go to the chat box, drop in some comments. I know for us in the South and the Southeast, that's where we love investing. Okay. We're moving through the recession into early parts of recovery, and we're really poisoning ourselves well for this growth. All right. Now, I don't mean to beat up on Austin, Texas. I love Austin, Texas. Okay. I'm a Texan at heart. Don't tell anybody. I know I live in Colorado. But Austin, Texas is in huge hypersupply right now. It's going to be a while before they move through this recessionary part of the trough into recovery. All right. So you have to understand, if you're going to take risk in your portfolio, okay, how does that align to the market cycle? Because you might be able to take greater risk here in phase 1 and phase 2, and then you need to hold on for phase 3 and phase 4. Okay, this is where I love investing in debt. And let's take a look at the debt cycle, how this overlays. When we've got our moving through recession and into the expansion phase, credit's available. All right, we're starting to see that kind of happen nationally. But for 2 years, it was really tough to get loans and to refinance things. Okay, there was a lot less credit available. So how can you take advantage of that as an investor? Well, for one, I encourage everybody, take a look at diversifying across all layers of the capital stack. Debt deals, maybe second notes, promissory notes, preferred equity. Add in those lower layers to your investing. Don't have everything in the equity part, okay? Because when the tide goes out, when the credit goes out, those deals are going to struggle. But if it's balanced out by your lower debt tiers, especially with cash flow, now you're going to smooth the volatility ride. Okay. All right. And so you're also going to want to match timelines. So if you are needing cash flow, you are matched really well right now. If you're in the cash flow phase of investing and you're willing to take, your risk is super low and you just want cash flow investments, they're plentiful right now because we're in this part of the market cycle. All right. But if you are looking for equity growth, nice solid equity growth, you're going to have to take far more risk in this part of the cycle, or you can wait a little bit and see what deals come online here in the next 6 to 12 months. Okay. So most importantly, let's build our own rules around investing, hence our investing plan. All right. I see a few comments coming in. I'll address those here in a second. Okay. And I'm going to bring it back. We're going to be very surgical and make some decisions now. All right. You have your goals, your risk, and timeline. All right. But I want you to analyze your current portfolio. You're not going to be able to do that right now. Based on your goals, risk, and timeline. All right. Gather up all the information about the operators you're invested in, the markets you're in, what deal and asset class you are, and what layer of the capital stack you're in, and then sit with it. Interrogate that portfolio. Does it align with what I'm trying to do? Right? There's only two ways you can mess this up. Way number one is that when you build your portfolio rules, that you borrow somebody else's rules. And we've already picked apart why that doesn't work. Okay. Investing rules is like a fingerprint. No two people have the exact same investment plan. Okay, so don't borrow somebody else's. Do the work for yourself. This can be like an hour. This can take like maybe an hour, hour and a half. There's no such thing as perfect balance between operators, markets, and deals, and blending parts of the capital stack. You have to look at what the market is giving you. We just took a look at market cycles and debt cycles. Okay. All right. Now we got to get into the math. But before we get into the math, let's back it up here. Any questions before we move forward? This is a great time for a couple cues that are related to the content we just covered. I got a hand raise. Go to the chat box because everything's disabled. Okay. So we take this and we turn it into a podcast. Go to the chat box, drop in your question. That would be great. Now, when you're looking at developing your investment rules, I think this is kind of a logical question. What we're trying to do is actually make these decisions up front. When you look at your total portfolio, how much are you willing to invest per operator? Okay, how much are you willing to invest per market? How much are you willing to invest per deal? How much are you willing or want to invest in each layer of the capital stack? All right. Now we're going to get into the math, right? We got to, some of you guys got goals, you have, things that you want to achieve, but we need to put these rules in place to help protect us. I'll give you an example. I had two investors or two operators that I absolutely adore. I love investing with, and I had to slow my roll in the past couple years investing with those operators just purely because I was overexposed to them. I had more than 10% of my net worth with them, which for me, when I really did the numbers and I looked at it, I was like, ooh, that's a lot. If something happened with that operator, they went out of business or whatever, I was going to be challenged. I didn't want to lose 10% of my net worth. Okay. I had one deal that I needed to get out of because I had more than 3% of my net worth invested in one deal, exposed to just one deal. I wasn't willing to do that. Now, some people, they have much different rules. They're okay investing 15, 20, 30% of their net worth with one operator. Okay, they'd rather double down with who they know. Some people are okay writing larger checks to the deals. But you have to decide what's comfortable for you and make those decisions up front. All right, I see some questions coming in. Since they don't really pay attention to what we were just looking at, I'll save those for the end. Step number 3, do the math. Now we need to do the math in both what we call a linear fashion, but then we're going to pay attention to compounding because that's where the goods are. So for you, I want you to write down your current invested capital, right? What do you currently have invested? What can you contribute on an annual basis? What are you going to deploy on an annual basis? Okay. And then what is your targeted return? Now, this is where it gets super fun because I have people that are like, I want to take 0 risk, but I want a 10% return. Well, it's not to say that we can't get that, but we got to kind of level set on what kind of risk we're willing to take in order to get that. Okay, this is where we get to create even more alignment. Now, the reason why we want to understand our current capital, what we have invested, and our targeted rate of return, or what our return is right now, blended, is that if for those of you who are looking at cash flow in the cash flow phase, this is going to determine, what you get. So if you have 1.5 million invested and you're getting a 6% return on your capital, that's $90,000 a year or $7,500 a month. But if you have 1.5 million invested and you can get a low risk 10% return on that money, now you got $150,000 coming in a year or $12,500 a month. Okay, very different, right? And then this is where we're going to level set it to the risk that we're going to take. But the next part of the math is compounding. For my people here that are like, okay, great, I need to actually grow my net worth because I don't have 1.5 million invested. I don't even have $500,000 invested. I need to grow that. How do I do it? You're going to compound it. Okay, you're going to take all of your money and you're going to continue to reinvest in your investing plan. It's your business. This is your investment business. I want you to treat it as such. Okay, you're going to continue to reinvest it until you hit the cash flow needs that you want to hit. Okay, now for if you're, we're going to look at some scenarios here in a second, okay, on ways that we can, do it low risk, take advantage of higher risk, but it's not necessarily about the net worth, right? We live off of cash flow, right? So the takeaway here is that we need to learn how to reverse engineer. And these are the two pivotal steps to help you reverse engineer your financial goals in order to hit what you want to hit. All right. So we're just going to run through like 4 quick scenarios here, and then we'll open up the floor here for questions in a minute. But here's an example of somebody who has a chunk of funds. They just started out $500,000 and they're just like, you know what, Whitney, I'm in my cash flow phase. I really just don't want to, I want to be able to grow it a little bit, but I don't want to necessarily swing for the fences on an equity deal because I'm just too close to retirement. I'm kind of like in that transition phase. You can get there because if you have $500,000 and you're able to add $100,000 a year from your income, and you're just continuing to reinvest your profits, year 1, you're making $45,000, but by year 7, moving some screens around, now you've got 1.6 that is compounded up, okay? And you're hitting $161,000 a year. Okay, this is how you can just like invest it and like let it ride. This is a great example of funds that are invested in what, like, say, like our debt fund right now. 500,000 would hit a 9% tier. Once it tipped over $1 million invested, it would hit a 10% tier. Another way to do this would be invest in something like our promissory notes right now that are offering either 10 or 12%. We would amplify, just scale this even further faster. Okay. Now, if we got out to year 10, that person would have 1.9 million, but they would have even greater cash flow. Okay. They could just lock that in. That say they quit at year 7 building, they would have, $161,000 in perpetuity every single year to live off of, right? Or they could continue to compound it and grow it. All right, here's another example. Somebody is like, "Ooh, I don't have a chunk of change to invest in up front, but I can invest $100,000 every single year. What does this growth look like?" Well, and I'm just using our debt fund as an example. They would start off at the 8% tier, okay? Annual distribution $8,000, but at 7 years, not too shabby. We're at $81,000 with just a modest growth every single year, okay? Dollar cost averaging. All right, now could we grow that further, faster? Absolutely. We could take greater risk up the capital stack if we wanted to, or we can just keep it nice and mellow and let time work for us. All right, those are the levers we can pull. Extend our timeline, add more to it, or take the greater risk in the return, juice the preferred return that we're going to get. Okay, here is an example with an equity deal. Okay, if somebody actually is in an equity deal and they're clipping that 7% coupon, that preferred coupon, they can reinvest it. Or like I said, I didn't take any cash out of this plan. Maybe that 7% just hits all in year 5 along with their capital gains. All right, they got a chunk of cash, they deploy it. All right, and they add to it $100,000 every single year. Year 5, they get their 7% preferred return. They're made whole on that. They've got their capital event that's happened. Okay. Now, hold on. Now, like you can see, their cash flow is like $104,000, but they've scaled their net worth pretty rapidly. Okay, they went from 500,000 to 1.4. Okay, and that continues growing over time. By year 15, they would have $3 million. Now, here's the thing, is that their cash flow probably would just rival what they would get if they put it in notes. They would just have a larger net worth. So again, you got to go back to your goals. What is important for you? Is it the cash flow or is it the net worth? All right. And then if somebody was like, Whitney, I have that chunk of change, you could do it modestly, by adding to it every single year. And again, you just got to allow either increase more money that you can put into the system, take more risk with the rate of return, or just give yourself more time to hit your goals. All right. Step number 4. All right, now that we've taken a look at a few scenarios on how to scale your wealth, we got to come back to that diversification. Okay, how can we as passive investors diversify? Right? We need to balance risk and opportunity and diversify across that capital stack. I cannot drive this message home enough. And, I used to say diversification came in 3 flavors: the operators you invested with, the markets you go into, and the type of deals or asset classes that you invested in. Okay, I used to say you get to diversify over operators, markets, and deals. The deals meaning you can also do the number of deals, but the asset classes of the deals. But you got to diversify across the capital stack, okay? Like debt funds, promissory notes, preferred equity deals, in order to smooth that ride in volatility, okay? That is the other way that you can create diversification as a limited partner. So ask yourself right now, what is your ideal mix between operator, market, and asset class? And what is your ideal mix across the capital stack? All right, we already introduced that, but I'm going to ask those questions again. What is your ideal mix? And if somebody has an ideal mix that they want to share, drop it in the chat. I would love to know. We could discuss it. All right. So that is kind of building our investment plan, but just because we built the plan, we're starting to deploy on it and actually take action. All right, you have to remember that you have to review and adjust your plan all the time. So I do a annual review. You could do it more often, maybe biannual if you'd like, especially if you're just now getting started. But remember, markets evolve. Remember our 4-phase markets that we just looked at. Remember, we looked at the debt cycle. And as the markets evolve, so will your goals. So make sure you're visiting your roadmap annually at minimum to reassess your goals, your risk, and your timeline. Make sure nothing hasn't shifted. Adjust your investing rules based on the market and debt cycles that you're seeing, right? And then optimize your portfolio based on what the market is giving you. Now, when I say optimize, I don't necessarily mean liquidate things and move money around. Of course, you can do that if the assets are, liquid, but optimize with the cash you're deploying, okay? Taking advantage of the market cycle. Now, here's the thing. I get asked all the time by investors, what is the perfect balance in your investment portfolio? Okay, when you look at operators, markets, and deals, when you look at diversification between the different layers of the capital stack, Whitney, what do you do? Well, here's the thing. I went on a mission to answer that question a couple years ago. I talked to all of the big players in the passive real estate space, and I asked them, hey, what do you do? What is the perfect balance? Okay, because I want to copy that. And they all laughed at me. Okay, or laughed with me, I should say that, not at me. Okay, they were just like, well, 1, my goals, risk, and timeline are different from yours, quite simply. And then number 2, I need to look at what the market's giving me. Those were the 2 big lessons. So there's no such thing as a perfect balance. So focus on what's in front of you right now. All right, guys. We have wrapped up the educational part of our show. If you're here live, we're going to move on to question and answers. But before we do that, if you haven't done so already, make sure to join the Passive Investing Club. There you can schedule a one-on-one call with me. We can discuss your passive investing goals and how we can help you here at passiveinvesting.com. You'll get access to additional education and resources and priority access to our deals. So visit passiveinvestingwithwhitney.com. If you're here live, don't go anywhere. We're going to start the Ask Me Anything part of our show. Awesome. I know several of you were like typing in numbers. That's awesome. I'm glad you're doing the work alongside. Somebody has a 20% return in their portfolio. That's amazing. I love that. Okay. Let me get out of here. There we go. Okay. Somebody asked, do we work with unaccredited investors? We call those sophisticated investors, not unaccredited. We are in the process of opening a Regulation A fund. So here I mean, it is imminent. Okay, probably in Q1, late Q1 next year. So stay tuned. This is a great time for you to reach out to us and get on our list. Well, you're already on our list, but like have a conversation with us. Let's get to know each other and understand your goals. And that way you can kind of talk through things. So yes, I'm super excited. We're going to have a Regulation A fund. It's been a long time coming. Somebody asked, interesting information on real estate cycles, being local. How do we identify the market cycle in each region in the US? Well, there's some resources that I would point you to. For me, I love following ITR Economics. They have a YouTube show called By the Numbers. And so they're constantly kind of, they don't go down to regional level. Okay, I'll tell you where to get regional information here in a second, but they're great for like national and like regional trends. But you can pay attention to them. Marcus and Millichamp, you know, if you're real estate specific, CBRE will put out reports as well. Cushman and Wakefield, kind of hit or miss, but those are the big three: ITR, Marcus and Millichamp, CBRE. CBRE, Marcus and Millichamp will put out more local type reports, maybe not on the economics, but the trends that they're seeing in real estate, say in Illinois, right? Or Carolinas. So they get a little bit niched down. And then, you know, paying attention to the local news is huge of where you're investing. And here's the thing, if you're already working with an operator, they are paying attention to all of this news, or they should be. So feel free to tap your operator for sure. Oh, somebody said, can we revisit market cycles and put them with the debt cycles? Yeah, we can do that here in a second. I'll pull that up. One more question. Do you think real estate has enough diversity as an asset class by itself so as to never need to consider other asset classes? Yeah, well, so real estate I mean, if you're in stocks, bonds, and mutual funds, they just lump real estate all together. But if you're looking at real estate, you can have single family. You can have primary. I mean, there's so many different ways to like mix real estate together. Multifamily, self-storage, express car washes, you know, debt, stuff like that, right? Multifamily or small, single family. If you're going to stay just in real estate, it is imperative. I cannot stress it. You have to be adequately diversified across the different layers of the capital stack. Why is that? It's because they're all on the same debt cycle. And that's that's how people got nabbed this last time, is on the debt. Okay, they were all taking advantage of the debt. Okay, so make sure, same thing goes with business. If you're all in business, you know, especially like Main Street type businesses, you know, half of them are going to be, if all you got to look at the assets in your portfolio. If you're investing in businesses and all of them have small business loans associated with them, right? If they're all on that similar type of lending, like you're going to want to diversify across the different layers of the capital stack. So, okay. I see some other questions coming in. Chris, I'll be with you here in a second. Let me figure out how to get back to my presentation real quick. Ah. Okay, so somebody asked, can we go back to the debt cycles and the market cycle? So here's the market cycle, 4 different phases, right? So if you guys can see my cursor, credit is available in the phase 1 and phase 2. Credit kind of goes away in phase 3, phase 4. Banks just they don't want to be exposed to hypersupply. They don't want to be exposed to a recession. They pull out and they sit on the sidelines. Okay, this is the opportunity for a limited partner investor to step in and provide debt in these parts of the cycles. Okay. Banks, they're like super, super scaredy cats. Okay. We want to make sure that we're underwriting assets extremely well, even if we're going to offer debt in these parts of the market cycle. We're going to want to have, some sort of level of guarantee on that asset. Like, we're going to do everything we can to mitigate risk here. But banks, they don't want to be ever, okay? They learned the lesson in 2008. They don't want to take back assets. Now, I can name 4 banks right now that fund multifamily deals that's their business. They want to foreclose on multifamily deals and take back the asset. I mean, their primary business was just to get the loan, but they're totally fine with foreclosure. And we've seen a lot of deals go down, from those 4 lenders. But anyways, that's how the debt kind of correlates here. Debt expands. Okay, credit's more available in phase 1, phase 2, phase 3, phase 4. Okay, we're going to see the bank credit evaporate, but you're going to see more debt funds pop up in phase 3, phase 4. You're going to see more private credit. You're going to see more preferred equity type deals in phase 3, phase 4 part of the cycle, because the bank competition is evaporated. When banks are offering near zero, interest rate loans, I mean, a limited partner, an operator just can't sell that deal to a limited partner. Hey, come earn a 3% pref with me. No limited partner wants to see that. Okay, did that answer your question? Somebody said, what are the layers of the capital stack? Okay, I'll show this. If you came in late to the video, because we only have 7 minutes left, make sure to go back and watch the video, because that'll be, as opposed to us, kind of recapping everything. That would be great. Let me see if I can get back there real fast. Oh, that's not working. Try one more time. Okay. So I'll just try to, so if you think of the capital stack like a pyramid, the capital stack is, sorry, Zoom is just not playing nice with me right now. Is like a pyramid. So your senior debt's going to be on the bottom, lowest return. Your next layer is going to be your secondary debt, like mezzanine debt, promissory notes, stuff like that. Your next layer past that is you're now flipped from debt to equity. That's going to be your preferred equity tier. Okay. Now, preferred equity works like debt, but it's not debt, it's equity. Okay, you're on the other side of the capital stack. And then your highest risk, highest reward tier is going to be the common equity class. And so when I had, a lot of investors who were like, man, Whitney, I was so spread out. I was in multifamily, self-storage. I was in mobile home parks, industrial, retail. I was in all these things. I was so diversified in my portfolio, and everything had a challenge here in the past couple of years. My mind's blown. I don't know why. Everything's paused. It's because you're all in one tier. What I found is that those investors were all in the common equity tier of the capital stack, and all of those deals experienced a similar issue, which was probably related to either adjustable rate mortgages or insurance going through the roof or taxes going through the roof in certain municipalities. Okay. In order to smooth that ride, you've got to diversify across the additional layers of the capital stack. And that's what we love helping our investors do here at Passive Investing. Somebody said, how do you invest in the different layers? Okay, well, I'll give an example of our portfolio and what we offer our investors. So in the senior debt position, the lowest risk, lowest reward, quote unquote, I'm going to say that because you can get a 6 to 10% preferred return. That's going to be our pick real estate debt fund 1. Okay, fix and flip real estate, super plain, super vanilla. Okay, you're just getting paid interest from the loans that are in that fund. Okay, if you want more information, reach out to me at whitney@passiveinvesting.com and we can talk. Any information about any of these deals. The next layer would be the mezzanine debt. Okay, mezzanine debt is usually offered as a second loan or a line of credit or something like that from the bank, or it can be a promissory note that's built in. And we have some promissory note. We have one promissory note open right now that can take advantage of that mezzanine layer. So you're getting a little bit more reward for a slightly higher risk in the deal. Okay, say like a 10 to 12% preferred return. Okay, but you're still on the debt side of things. Okay, the next layer is the preferred equity. Okay, this is where it looks like debt, smells like debt, but it's not debt, it's equity. Okay, that would be our alliance fund. Those are, that's a preferred equity fund that's going in and helping multifamily deals reposition so they can stabilize and exit in 2 to 3 years. Perfect. Yeah, somebody said, I think a capital stack slide would be great for good for clarity. Yeah, we had it in there. Sorry if we cruised right past it, but you guys will get the recording. All right. I can take 2 more questions. So if you got any additional, I hang out for a couple minutes, but I do have a hard stop here in a couple of minutes. If you want to invest with your Roth funds, I take it you have to set up a self-directed Roth, or could you invest out of your Roth IRA at your brokerage account? So I'll answer that first question. You have to, in order to go into a private equity placement, like say our real estate debt fund or our promissory note or our alliance fund, or even into a common equity deal with us, even with any other operator, you have to have a self-directed IRA. Okay. It's only because your brokerage account, they don't want to manage that. They're lazy. They're like, you can do stocks, bonds, and mutual funds all day long. We make really good commissions from that. So we're going to be lazy and not offer that to you. It's not lazy. It's just their business model. Okay. So you got to go with somebody like Advanta IRA. That's who I have. But there are great other companies out there. Is self-directed. Do you have any companies to recommend? For me, my experience for the past few years has been Advanta IRA. I love them. If you want a connection, reach out to me at Whitney@passiveinvesting.com. There's also some other IRA companies that we've interviewed on our passiveinvesting.com channel you can check out. What are the average fees? Every single IRA is going to have a different fee set up. But most are around $200 to $300 a year just to have the account open. And then you're going to have your transaction fees in there. But it really boils down to how do you structure things. So I would always talk to 2 or 3 different operators for sure. Or not operators, IRA companies for sure. All right, one last question. How do you calculate net worth when you have substantial monies invested in multiple investments with a 3x exit multiple as an example? Okay, your net worth doesn't change until the deal exits. Okay, the operator is not going to give you a new valuation above and beyond what what you wrote the check for the deal. So whatever you invested in that deal, okay, that number is going to stay the same. Okay, your equity. Now, any cash flow you get back, you can add that to your net worth. So it's growing, right? And then any compounding you get off that, it's going to grow. Okay, and then when the deal exits, you're going to get that check back. Now you can now that deal will 3x or whatever, then you add that there. But this is important to understand because if you're working with a broker dealer and you're trying to figure out how to get accredited, in passive real estate, you can't use the future valuation of a deal. Okay, it's always just current valuation of the deal. Okay. Guys, it's been amazing, amazing questions. I would love for you to reach out to me directly. Let me know, what did you love? What would you love to see? And we are going to do our next boot camp in January. And so I don't have the topic in front of me right now, but as always, thank you so much for taking the time, not only to be with me here, but also to invest in yourself. Take care.